everybody, and welcome to Looking at the Markets with David Modell. For you options traders out there, or you're thinking about trading options, here is a very simple and repeatable strategy. It's called the wheel options strategy. It's called the wheel because, well, I'm going to show you what it looks like. The strategy kind of resembles a wheel, and it's cool because you can do it over and over again. Now, before you get started, you need to know that first you need to have options trading permission with your broker. So you're going to want to contact, if you want to do this, you're going to want to contact your broker's customer service and find out what permission of options trading you have. Do you have permission to sell covered calls? You probably do if you have an options trading account, because that is usually the lowest and simplest level of options trading, selling covered calls. But you also, to do the wheel strategy, you also need to be able to sell a put option, a cash covered put option. And that means that you're going to sell a put, and then you'll have the expectation of possibly and hopefully getting assigned so that 100 shares of the stock will be put to you, meaning you'll have to buy 100 shares at the strike price of the put option contract that you sold, and you'll need to have the cash available in your brokerage account to buy and pay for 100 shares of that stock. So this is something you should only do if you have that permission. First of all, you'll need to have permission to sell cash-covered put options and also permission to sell covered calls on 100 shares of stock. Also, you need to be able to afford to buy 100 shares of stock. And so you might not be able to do this on a more expensive stock like Amazon or Google or something like that. But if you can, great. If not, then you might need to look for less expensive stocks that are optionable, meaning that you can buy and sell options on them. Okay? And both parts of the wheel strategy involve selling options. At no point are you buying options in the wheel strategy, although you will be buying 100 shares of stock. So let's take a look at the wheel and how it works. All right, so here's your wheel. I drew it, and I'm not very good at drawing, so hopefully you will forgive me for that. All right, the first part of the wheel strategy for options is you sell the put option. And that's going to be a cash-covered put, and only do this if you have the cash available to buy 100 shares of a stock, and if you really want to buy 100 shares of that stock. Okay? Don't do this for anything you cannot afford to buy, and any stock that you cannot or do not want to buy 100 shares of. All right? Never sell a cash-covered put option if you're afraid of the price of the stock going down and you might have to buy 100 shares of stock. If you're afraid to do that, don't do this, okay? This is something you really want to buy 100 shares on, all right? So you sell your put option, and what should the strike price be? What should the expiration date be? That's up to you. That has nothing to do with the wheel strategy. I have a tendency to sell an at-the-money cash-covered put option, just because you get the greatest premium payment up front compared to the amount of risk that you're taking on. So that's my preference, but that has nothing to do with the wheel strategy itself. Also, expiration date. A lot of people have said that 45 days out is the way to go, or as close to that as possible, or perhaps at least 30 to 60 days out. Closer to 45 is even better when it comes to selling a cash-covered put option. But again, that's up to you. That has nothing to do with this strategy. All right, so first step is sell a cash-covered put option. Okay, now what if you don't get assigned? Okay, let's say you sell the cash-covered put option, and then the price of the stock just goes up, and it never goes below or doesn't stay below the strike price. Okay, so you will not take ownership of 100 shares of stock, but you got paid a premium payment from selling that put option. So you win, really. I mean, you got free money, basically. You sold what ended up being a worthless contract, a put option contract. So nothing wrong with that. It's tough luck for the person you sold the put option contract to, but pretty good luck for you. and good strategy. Okay. But you're kind of hoping to get assigned, because by getting assigned, you can then continue through the wheel, which goes clockwise here. Okay. So if you do get assigned, okay, let's say the price of the stock goes down, and now you get assigned. You get put 100 shares of the stock. Okay, get assigned. That's the next part of the wheel. And so I guess I should have drawn an arrow from here to here, but my drawing skills are terrible. So I hope you'll forgive me. Okay. So you get assigned. Now you own 100 shares of that stock, all right? So the contract, the put option contract is not valid anymore because it was exercised. You own 100 shares of stock, probably at an unfavorable price, unfortunately. So you're down a little bit on your purchase of the 100 shares, although you did get paid a premium payment up front for selling the put option, so maybe you're not behind very much. In fact, you could actually be ahead a little bit there, or break even perhaps. All right, but that's not the end. Okay, so you get assigned. All right, and so you're probably behind in terms of the stocks are down a little bit. All right, compared to where you had to buy 100 shares. Okay, so you're down on your stock position, your 100 shares, no big deal. All right, you got assigned. You were ready for that. Okay, you were willing and able to buy those 100 shares, even not at the best price necessarily. Okay, you got assigned. What's next? Well, now you have 100 shares. Do you just sell them for a loss? No, you don't sell those 100 shares for a loss necessarily. Not if you want to use the wheel strategy. I mean, it's up to you what you do. You know, don't do something because I'm telling you to do it or because anybody told you to do it. All right, you have to make your own decisions. So you have 100 shares of stock, and you decide, yeah, you want to continue around the wheel. So here we go. What's the next step? You start selling covered calls. All right. And this is a process that might take a while. So let's say you sell a covered call. Where do I sell it? Usually at the money. Okay. What expiration date? Well, 45 days is pretty good, but that's up to you. You know, between 30 and 60 days is pretty good in my experience in selling an at the money. Get a decent premium payment up front, right? You know, cash right into your account for selling that covered call on those 100 shares. All right. And so you start selling covered calls. So you sell a covered call, and if the stock price goes up above the strike price and you get assigned, great, you sold your shares. All right. Now make sure that strike price is at least where you want that strike price not to be too low. Okay, because you don't want to sell for a huge loss on the 100 shares of stock. All right, so you want to make that strike price at least where you bought the stock, where you bought the 100 shares, so you won't have to take a loss on the 100 shares of stock that you bought. All right, that's at the money, I would say. So I'm selling an at the money put, meaning about the price where I was assigned. All right, so I'm not taking a huge loss. So I'm selling a covered call. Now let's say I sell it 45 days out. 45 days come and go, and I don't get assigned. The stock just stays down. All right. So if I don't get assigned, then I just keep selling covered calls. I sell another one and another one until I finally get assigned. If you get assigned the very first time you sell a covered call, great. Okay. If you don't, hey, at least you're collecting premium payments because you keep selling covered calls until you get assigned, which may take a while or it may happen quickly. If the stock, just depends on when the stock price goes up above the strike price, right? But again, if the stock price keeps going down and down and down, don't keep selling lower and lower and lower strike covered calls. That's not the idea, all right? If the stock price just keeps going down, then you may have to wait. You may have to wait for the stock price to come back up before you keep on selling those covered calls, because you don't want to sell your shares super, super low. That's not the idea. Okay, you may have to wait until stock price comes back up to about where you had to buy them when you got assigned from the put option. Okay, so you sell covered calls until what happens? Until you get assigned, and hopefully you'll get assigned either at the same price you got assigned here with the put option, okay, the price where you bought the stock, or maybe even higher. Try not to do it lower if you can help it. All right, you're not trying to sell for a loss with the stock. And so let's say, what if these two prices were the same? Let's say you bought 100 shares and then you sold the 100 shares at exactly the same price. Okay, so meaning the strike prices were the same. All right, so you collected a premium payment when you sold the the cash covered put option in the beginning, and then you got paid again and again, or at least once, with the covered calls that you were selling. All right, and so you got paid just through the options, even if you didn't get paid, with the stock. Actually, you can get paid with the stock even if that happens, because let's say you collected a dividend payment along the way. That could happen. You get assigned 100 shares of stock, and even though you sold a covered call, you could still collect dividend payments. As long as you own those 100 shares, you're entitled to those if you get them. All right. But once you sell your stock shares, then you're done collecting dividend payments if you did it all. All right, so 3 possible ways to make money. Actually 4, really. When you sold the put, right, cash covered put. When you sold covered calls, maybe a dividend payment is a 3rd way you can get paid. And then there's a 4th possible way if you put the strike price of the covered call that you're selling, or covered calls, if you put them higher, okay, higher than where you bought the shares, which some people choose to do. So you'd be selling an out of the money covered call. And then you might make some money off of the price appreciation of the stock shares until you get assigned. So that's another possible way. Okay, 4 possible different ways to make money, but you're at least making money from 2 ways: selling the put and selling the covered call or calls. All right. And you go through the whole wheel, and then you just repeat it until you get rich. Thanks a lot. Bye.